In this video, traders, we're going to look at 4 useful chart patterns to use in range-bound conditions. So when we haven't got a specific uptrend or downtrend, markets oscillating around, tight range, narrow range, but just not really breaking into new ground. Let's see. Hey traders, warm welcome to you. All right, so range-bound markets are pretty common actually. You know, we like to think and we talk about trending environments because that's when generally it's most lucrative to get involved. We've got persistency of trend. We can jump on the trend, crutch it, eke a little bit out, take a little bit of money, put it in the account, look for the next move, look for the next move. But range-bound environments are really what the market is doing most of the time. You know, even if you look on a larger time scale, you see sometimes, you know, even though there's little mini trends within ranges, you know, very often we haven't broken out of a key high or low for a long period of time. That's true for a lot of commodities. It's true for a lot of currency pairs. And yes, there are short-term trends like we say we can jump on, but how about if we have a range-bound environment on the time frame we're trading? What are the sort of chart patterns that are pretty effective for actually trading that? So I've got 4 for you now, and the first one is a simple fade extremes. Now, there's a slight twist to this. We'd normally draw our support and resistance levels on, pretty standard stuff. You know, we find a lot of price bouncing off a level, that's our support, resistance, that's our, to the upside, that's our resistance. And we tend to bracket it like this. So we'd have a range here as our first level here. And normally people will stop at one level, but I'd like to add a couple more because guys, in the real world, we don't get this very, very clean range bound environment. And yes, you know, when I'm just drawing on the board here, we tend to have that, end up smudging that off. We tend to draw that and it's all nice and perfect. But the real world isn't like that. It's a little bit more, you know, we break through a little bit, we come back a little bit, we mess around a little bit. So having 3 levels, if you like, of support and resistance outside your range allows you to play a little bit of a clever game. Because what you can do is then you can say, right, I'm allowed to add, and I can use one as an add position, and I can use one as a stop position. So let's say it's broken out of 1, you can then say, right, well, if it breaks out a little bit more, I'm not gonna have a stop so tight because we're still range bound. So I'm gonna initiate my short position at 1, initiate my long position at 1, I will add to the position at 2, and then when it's very significantly over, then that will be my breakout. So there's one little twist, and again, and never recommendations, guys, but just the way that I like to sometimes play these ranges, rather than being very strict and just saying, okay, I'm going to fade it at 1, I'm going to come out if it breaks the high. They tend to do that. They tend to kind of squeeze out and do bits and pieces. So you've kind of got 2 choices. You either play that game and get prepared to be stopped out and re-enter, which is fine, or you give yourself a little bit of room. It ruins the risk reward very slightly. That's the only downside to it. But if you add to the position, again, knowing your full risk, you don't want to be adding blindly, but if you're adding slightly, giving it a little bit more room and using a tiered based support and resistance system around the extreme, that can work in your favor. The other one, guys, is Wicks and Tails. So, you know, very often we get these fake outs of ranges. So this would be our range, and this would be what it looked like from a candlestick basis. You know, we get the intraday move out, especially if that's a daily candle, get the intraday extension to the high side, fails, comes back. So we're waiting for that rather than preempting that, waiting for that. Once we get that, the nice thing about it is, okay, like any trading, guys, we never know what's going to happen. But the good thing about this is we say, okay, we've got a good place for our stop. If that's a genuine extreme, we shouldn't expect it to go any higher. Can initiate short position there. By the way, just flip it on its head if we're looking for a long. We know where to get in, wait until the end of the day. We know where our target is going to be at the bottom of the range. It works nicely. In actual fact, very often we end up getting an additional breakout of the range there once it's failed and it's realized that it hasn't got any buyers to the upside. So that's quite a nice trade, guys. You know, very simple, very methodical. You ain't got to think about it too much. You can just trade these ones all day long, and over time, you know, get the result you want. So next one here is what I call the Keltner Fade. So you can use a Keltner, or you can use a Bollinger Band. You know, ranges, again, they can be kind of look like they're in uptrends and downtrends, but you're still within a range. I'm not talking about a channel here. We're talking still the range, but very often just not being as clean as we'd like. So using a Keltner, which is based on an ATR, or a Bollinger Band, which is based on a standard deviation, can just give us a reference of when to kind of initiate the short position or the long position. And the idea being that when we're at the extreme of the Keltner or the extreme of the Bollinger Band, we're looking to initiate. Now, you're gonna need something else to actually pull the trigger on this, because very often it will hug the upper Bollinger Band for a while before rolling over. And if you're just blindly selling into the upper Bollinger Band, it's difficult to quantify the stop. You almost need a range to see it kind of roll, or maybe it's something like top Bollinger Band, 3 days in a row, right, now I'm going to initiate a short. Bottom Keltner, 3 days in a row, initiate a short on day 3, midday and day, something like that, some extra little tweak and adjustment that allows you to use it as an alert, if you like, but then something a little bit stretched, and then you're taking it, and then you're pulling the trigger on the counter trend trade. Fourth one, guys, I've got for you is to wait for the break. So you don't have to get involved with the range at all. You can say, okay, you know what, I prefer to have a momentum ignition type trade, prefer to wait for a bit of movement in one direction, and then I'll wait for something to come back. So the classical, breakout, pushes through the level, pushes high, pushes back, comes down, finds some support, goes again. Once it starts to go again, any sort of area here is the best possible position, and then of course your stop is always going to be under here in case it's doing one of these type of things, but actually it would look more like this, wouldn't it? Which isn't unusual. These things are perfectly feasible to happen. This is none of this is holy grail stuff, guys, but you get a decent risk reward with this kind of thing. If it starts to go, it will go, pull back. And I've noticed actually right at the moment, FX markets are prime for this kind of thing. Get the break, starts to go, gets a lot of people excited, pulls back, gets them worried a little bit, and then as a second wind where the throttle really goes down. So that's something you have to trade the actual range. You can wait for the break and break up there. So we've got the fading extremes, guys, with this kind of different levels on each. I quite like that. Wicks and Tails, very useful for quantifying your risk. The Keltner or Bollinger Band fade, and then waiting for the break and just not getting involved until it actually does something meaningful. Take care, guys. See you in the next one. Don't forget to check out our channel sponsor. There's a link to them in the description below. If you've got any comments, questions, etc., always interested to hear what you guys have got to say. Take care. Bye-bye.